it's just very important that the debt ceiling be raised in a timely fashion so that the United States can pay its bills when and as they come due. That's a critically important thing. The failure to do that is something that could result in severe reactions, severe damage to the economy and to the financial markets, and it's just not something that we should contemplate. I'm not going to comment on particular tactics or things like that. I'm just going to say that I think we can all agree that the United States shouldn't default on any of its obligations, should pay them when and as due, and that no one should assume that the Fed or anyone else can protect the markets or the economy in the event of a failure, fully protect in the event of a failure to make sure that we do pay those debts when they're due.
Good.
If progress continues broadly as expected, the committee judges that a moderation in the pace of asset purchases may soon be warranted. We also discussed the appropriate pace of tapering asset purchases once economic conditions satisfy the criterion laid out in the committee's guidance. While no decisions were made, participants generally view that, so long as the recovery remains on track, a gradual tapering process that concludes around the middle of next year is likely to be appropriate. The timing and pace of the coming reduction in asset purchases will not be intended to carry a direct signal regarding the timing of interest rate liftoff, for which we have articulated a different and substantially more stringent test. We continue to expect that it will be appropriate to maintain the current 0 to 1/4% target range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessment of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time.
Stocks on Wall Street shot higher Wednesday after the Federal Reserve took another step towards easing its massive bond buying program aimed at supporting the economy. The Fed said it may soon reduce its monthly purchases. Henyon and Walsh Asset Management Chief Investment Officer Kevin Mon said investors took that as a dovish stance.
I think what they welcome most is that there's not going to be any sooner tapering than was originally anticipated, that there may likely only be one rate hike in 2022, and as it stands right now, only one rate hike in 2023. That only moves us up 50 basis points from where we are right now.
Stocks bounced back even before the Fed announcement as concerns eased over a default by property developer China Evergrande. Energy, tech, and real estate stocks led the advance. The Dow, S&P 500, and NASDAQ added roughly 1%. Shares of FedEx were the biggest decliner on the S&P, descending 9%. The package courier slashed its full-year earnings forecast. The company is struggling with a labor shortage that drives up costs and slows deliveries. Chevron was the second leading gainer on the Dow, rising nearly 3%. Oil prices climbed, driving up energy stocks, after industry data showed U.S. crude stocks fell more than expected last week in the wake of two hurricanes.
The Federal Reserve cracked the door open ever more slightly on Wednesday for the so-called tapering. That's when it will begin to pull back on its massive bond buying program aimed at stimulating the economy. While Federal Reserve Chairman Jerome Powell said the Fed's criteria for inflation has been met, and the goal of spreading out employment gains more broadly throughout the economy has, quote, all but met his standards, the health crisis still poses a risk to the economic recovery, at least for now.
While no decisions were made, participants generally view that, so long as the recovery remains on track, a gradual tapering process that concludes around the middle of next year is likely to be appropriate.
Powell says an announcement could come as early as the Fed's November meeting, but that depends on what happens with the jobs market. While the Fed is happy with the progress, August's sharp slowdown in hiring and the ongoing labor shortage are cautionary tales, which the Fed is willing to give another month or two to watch. Also looming over the Fed, the possibility the federal government fails to reach an agreement to raise the debt ceiling by an October deadline and defaults on its debts for the first time in the nation's history. Powell warned of the devastating impact that could have.
The failure to do that is something that could result in severe reactions, severe damage to the economy and to the financial markets, and it's just not something that we could contemplate, that we should contemplate. No one should assume that the Fed or anyone else can protect the markets or the economy in the event of a failure, fully protect in the event of a failure to make sure that we do pay those. That's when they're due.
As long as a debt crisis is avoided and the economic recovery remains on track, the Fed seems comfortable and ready to do less, quote, soon, with half of policymakers predicting a rate hike could come in 2022. Robinhood, the popular stock trading app that sparked a trading revolution and helped make meme stocks a new phenomenon, is making a deeper move into cryptocurrencies. The company will begin testing cryptocurrency wallets next month with a plan for a broader rollout next year, Robinhood revealed on Wednesday. The wallet will allow users to transfer supported digital currencies in and out of their brokerage accounts, permit users to make actual purchases directly from the wallet, and allow them to participate more broadly in the blockchain ecosystem, like buying NFTs or non-fungible tokens. The change has been the most requested by Robinhood's customers. Right now, app users can only buy, sell, or hold certain cryptocurrencies like Bitcoin and Dogecoin. Cryptocurrency trading has surged so much on Robinhood that last quarter it exceeded stock trading on the app for the first time. Investors are eager to see the app diversify its source of revenue after a disappointing market debut in July. The stock is up 15% from its IPO price. That's a meager gain compared to other IPOs.